Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. Let's get you up to speed on the market action. 3 p.m. Eastern, 1 hour left to go in the trading day. We've got a bit of a rally on our hands. The Dow up 370 points, the S&P 500 up 39, the Nasdaq up 124. Sentiment in the market helped by a solid debut from chip designer ARM. We're going to get to that in just a bit, but we did get a mixed bag of data this morning. Producer price index from August showing that core PPI held pretty much in check with an increase of 0.2%, which is in line with what economists were expecting. Retail sales, though, came in above expectations, rising 0.6% month on month. And we did see bond yields move higher on the back of some of that. But Shauna, all eyes on ARM today.
All eyes are on ARM right now, and Akiko, that is where we want to start. The stock story of the day, ARM making its much anticipated public debut. You can see it trading right there on your screen. Now just above 58 bucks a share, up about 14% here in today's trading session. This coming after shares were priced at 51 bucks a share. Our own Josh Lipton is here, fresh off of his interview with the CEO of ARM Holdings. Josh.
That's right, Shauna. So it's official. ARM has returned to the public markets, and we did just get the chance to speak with ARM CEO Rene Haas. Of course, we talk about ARM because it is one of the most important semiconductor companies in the world. Its chip designs are ubiquitous in smartphones, from Apple's iPhones to Android devices. Of course, the smartphone market, though, is under pressure. So we asked the CEO whether the smartphone market is still a growth story for his company.
I think it is, from the standpoint of these devices are more and more complicated to build. While the smartphone market has saturated in the last number of years, the complexity of technology inside has not. And they get more and more powerful, they require more and more technology. And your mention on market share means the opportunity for ARM to bring more value is there. So I imagine our growth will come from bringing more value into the smartphone sector.
We also asked Rene Haas about the transition to AI and machine learning, of course, where he also sees opportunity. Remember, AI powerhouse NVIDIA has a super chip for the data center called the GH200, which uses ARM's CPUs.
It's impossible to build AI without ARM. AI for us generally means where you didn't have a CPU, you may need one. Where you have a CPU, you may need more. And that is across all markets. It's in autonomous vehicles. It's in edge devices like your Google Assistant, your Amazon Alexa. It's also in the cloud. And NVIDIA has announced their most advanced product called Grace Hopper, which takes what was an x86 CPU and replaces it with 72 ARM CPUs connecting to a NVIDIA GPU. You can't run AI without a CPU. You can't run a GPU without a CPU. So the AI growth curve for us, we're super excited about what that means.
And finally, we did discuss China, which is an important market for ARM, accounting for about 25% of its revenue. We asked Rene Haas about the opportunities and the risks of doing business in China right now.
So the growth in China for us in the last few years have been very similar to other areas. We've grown a lot in the data center. We've grown a lot in vehicles, automotive. There's a huge push towards EV in China. China wants power efficiency. China wants open software ecosystem. Those are all strengths for ARM. You know, I would say in terms of the risks with China, my worries are no different than any other tech CEO in terms of navigating through the complexities of that. But broadly speaking, you know, China's been a very good market for us.
ARM seeing a nice boost in today's trade, a smooth-looking debut. And one question is whether private companies waiting in the wings now see this reception and decide maybe they, too, are willing to take the public market plunge. Back to you, Will.
A strong open here for ARM. All right, Josh, great stuff.
Right.
Thanks.
Well, ARM shares continuing to trade higher after its public debut earlier today. The question, though, what does this mean for the IPO market as a whole? We're joined by Mark Roberts, the Blue Shirt Group Managing Director, and Janae Ter, Crunchbase Senior Data Editor. Mark, I'm going to start with you because you said that ARM would, in fact, emerge as a bellwether tech stock. I realize it's just day one, but what does this bump on day one mean when you look at the context of the broader IPO market and where it's been up until now?
Well, look, I think it's a great data point. Hopefully, the first of maybe a small data set. The market. This was a deal that had a great company that is scaled and profitable, and really ran a tremendous process of informing the buy side of all the growth drivers behind it. So I was not surprised, or I am not surprised that it has done well here. And I think This is a great first step to reopening what has been sort of an 18-month drought of IPOs in the U.S. tech markets. Last thing I'll say is I think it really does start to build a better emotional vibe in the boardrooms of small and mid-cap companies who can now look at this and potentially see a pathway to a much more active 2024.
Janae, do you agree that this strong debut here from ARM, that is going to be enough here to help thaw some of the, I guess, the fact that we haven't seen much activity at all in the IPO market?
Yeah, I think the fact that the IPO has gone very well today and over the last few days is a strong indicator. I talked to an analyst this morning and he said, if you're looking at the IPO markets thawing, you can't just focus on one company. It has to be a few companies that are listing. And the fact that two other very strong companies, Klaviyo and Instacart, are planning to go public this month means that this is a bellwether, but it needs a little bit more than just one company to list to give a sense of a shift. I think the fact that ARM has done incredibly well in opening, and I think they could have even gone higher. They talked about it being 10 times oversubscribed. They could have even jumped the price a little bit higher. They went on the higher range for this IPO, but they didn't go too high, I think is important because everyone's looking at pricing. And if they price it too high, that could certainly dampen the market. So I think it's been interesting to watch the sort of conservative pricing that we've seen around this ARM IPO. We know that SoftBank acquired a 25% stake from the Vision Fund at $64 billion. So certainly they could have pushed this higher and they didn't. And I think that's because of the space we're in as a market right now.
Janae, let's talk about what this means for SoftBank. They're certainly one of the companies that needed a strong debut when you consider they're the ones that took ARM private. 90% stake, roughly, 90% of the shares owned by SoftBank. They have been hit by their investments in other tech firms as well. But they've also been the driving factor behind those higher valuations we've seen in years past. What does this ultimately mean for the Vision Fund?
Yeah, I think what's interesting, this is an incredibly important company for SoftBank and incredibly important that the IPO went well for SoftBank. So this is strategic for them. It's one of the largest IPOs, so there's going to be a lot of eyes on it in the last few years since Rivian went public. But I think what's also interesting is we run the Crunchbase billion dollar unicorn board. There are more than 1,400 companies, private companies, valued over $1 billion. We hear from analysts around 100 to 200 companies, a lot of them on that list, will be looking to the public markets in the next few years into 2024 and 2025. And what's interesting, when looking at the board, is that SoftBank is one of the most active investors. It's second to Tiger Global in having the highest count of portfolio unicorn companies. So for SoftBank, through the Vision Fund, which invests in these companies, it is not just focused on this IPO, it's focused on liquidity for the Vision Fund for the next 5, 10, 15, 20 portfolio companies that could possibly go public. And so, as I said, there's a lot riding on this for SoftBank, but there's a lot more. There's many, many more stakes that they have in private companies. And I just looked at the average amount that they invested when they led around was, around 200 to 250 million. So they've been leading, as you said, these very large fundings at the later stages, and they definitely need liquidity.
Mark, with SoftBank retaining control of 90% of the company, less than 10% of the shares being floated, what does that mean in terms of volatility or some of the price action that we could see in the stock from here on?
Well, I think obviously they're solving for dilution, right? So there's 10% of the float, as you mentioned, out. I think looking at the amount of trades that have happened today, almost 100 million shares, it looks like, it's really traded quite consistently up, and it's sort of an old school execution here, up 15%. I think, again, just going back to the inherent attributes of the name, if you're a technology portfolio manager, you're going to need to either own or be very up to speed on ARM because it's just going to impact so many areas of the tech ecosphere. So I think it's going to trade well here, but it will be important to see where it's trading in, say, 30 days, because that's another data point that I think a lot of private companies will be looking at as well.
Mark, Janae talks about some of the other unicorns that are kind of waiting in the wings. We've got obviously Instacart up next as well, but you look at a company like Instacart. I mean, they're looking at what would essentially amount to a down round by going public. Certainly not getting the kind of valuation in the public market that they got in their last private funding round. When you look at those companies that are looking to make exits into the public market, is that sort of the reality right now, given how these companies are being scrutinized by investors?
Yeah, I think so. I think, look, coming out of the euphoria of 2021, you had really quite compelling valuation multiples. Those multiples came down in the face of, macro risk and company underperformance. I think we're in a new world where management teams have had 18 months to get used to the new normal in terms of valuation multiples. And I think one way to manage for that is to do smaller deals, manage for dilution, and execute in the public markets where you'll be rewarded and the stock price will go up and to the right. I also think it's really important for these private companies to establish relationships with the investment community earlier, because in talking to investors, my sense is you are not going to have this shotgun approach to buying every IPO in 2024. You're going to have investors doing a lot more diligence. They're going to have a lot more connectivity with the companies that they're excited about, and they'll put more money into less companies. So you want to be on that short list. And as a result, I think there's a lot of good work you can do as a private company getting ready for your IPO, say in the middle to back half of 2024.
Janae, what trends do you see emerging from this? When you take a look at the pop that we've seen, at least today, in ARM, what that tells us really just about investor expectations.
Yes, I think, what this tells us is that the companies who've been preparing to list, and as I say, it goes all the way back to 2021 and wanting to go out and not quite being able to do it. I think this is going to be a good indicator for those companies that this is the time to get serious. And so I think we're expecting, through the end of the year, there might be a few more companies who will test the waters and possibly come out. But definitely into 2024, I think there's going to be a lot more activity. Obviously, it's riding on these 3 companies that are going public and how they do not only on listing, but also a month or 2 out from listing.
Certainly a lot riding on these public debuts. All right, Mark Roberts, Blueshirt Group Managing Director, and Janae Tier, Crunchbase Senior Data Editor. Thanks to you both.
Thank you very much.
Well, we are just getting started here on Yahoo Finance Live. Coming up on the other side of the break, are the markets too quiet? We are going to speak with Schwab's Jeffrey Kleintop on what could be the next market catalyst. And the clock is ticking. UAW workers are set to strike at midnight if a deal is not reached. We are going to hear from former Chrysler CEO Bob Nardelli. Plus, we'll bring you a key earnings report after the bell. We'll hear from Adobe. All this and more on Yahoo Finance Live.
If the markets have taught us anything at Yahoo Finance, it's that things are always moving. Some big news from us, and it's a big mover, literally. We're headed to where all of the movers and shakers live. Yahoo Finance is taking its shows on the road. We'll be teaming up with the New York Stock Exchange and Nasdaq. This puts us right in the action at a pivotal moment for investors. While we're there, we're putting the finishing touches on our new studio and new shows designed for you, the viewer, to help you stay informed and help you make critical decisions throughout the investing day. So come with us on this journey and be part of this exciting time for Yahoo Finance.
Got 45 minutes to go until the closing bell. This market check sponsored by Tasty Trade. We're looking at a rally here across the board. The Dow right around the highs of the session, up about 370 points. You're looking at the S&P up about 1%, as well as the Nasdaq. The strong debut here from ARM in its public debut, shares popping here on the first day of trading. That's helping investor sentiment today. We also got a decent report here, a couple of strong economic data prints out this morning ahead of the bell. That's helping investor sentiment as well. And taking a look at the VIX pulling back just a bit. The fear gauge index here pulling back just about 4% at 1295.
Well, we saw oil prices spiking above $90 a barrel for the first time since last November. Let's bring in Yahoo Finance's Inez Ferre, who's tracking the oil patch or energy patch for us today. Inez.
Yeah, that's right, Akiko. And WTI crude oil, West Texas Intermediate, that settled at $90.16 a barrel. You can see on our Wi-Fi interactive board in after hours, we're seeing that oil is also higher as well. Brent crude at $93.70 per barrel. That's where it settled. I spoke with Andy Lippo of Lippo Oil Associates, asking him where he saw oil headed. He said that for some time, he's thinking that for the near term, you can expect prices to be around the $90 range of what we're seeing, because he's saying to me, look, Saudi Arabia, OPEC plus, but specifically Saudi Arabia really needs to fund internal projects, and they want the price of oil to be higher. And specifically with the unilateral production cuts that they have done, the ones that also Russia has done, that is putting a floor on these prices. It's actually lifting these prices. Is $100 a barrel out of the question? Look, RBC Capital is saying, no, it's not. It's not their base case necessarily for the end of the year, but they are saying that if momentum continues, you could see $100 oil. The question is, how long can the economy sustain this level of oil prices? Because you do see it impacting inflation. You see it impacting consumers, because consumers really only have so much disposable income. If they have to spend more on things like gasoline, then they're not spending more on other things. So it's only a matter of time before you see the high elevated oil prices really impacting the economy, guys.
Yeah, and a number of industries, including the airlines, now kind of raising the flag there about higher prices coming as a result of higher oil there. Inez Ferre, thanks so much for that.
Thank you.
Two hotter than expected economic reports out today. Producer prices ticking up in August, mostly driven by rising energy costs, and retail sales also topping expectations, proving that the consumer is still resilient. That was also driven higher by gasoline prices. Joining us now, we want to bring in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, it's good to see you. So when you take a look at the market's reaction, yes, we also had the public debut of ARM today, but focusing first on the econ data prints out this morning, it seems like investors maybe are taking this as the Fed is likely to pause next week, hold rates steady where they are. Do you agree with that?
I think the market is increasingly convinced that the Fed is done. And now maybe with the signal today from the European Central Bank, that all the major central banks are now finished or very close to being finished with rate hikes. And that's a bit of a relief. But boy, if you take a look at what the market's priced in, we've got the VIX now below 13. We haven't seen volatility this low since pre-pandemic period. So the market's certainly pricing in clear sailing from here. And it may not be that smooth of a ride.
How big of a concern are these higher oil prices? I mean, I realize that the Fed looks specifically at core inflation, which strips out energy and food, but you know, we have seen those prices go higher as a result of higher oil. At what point does that start to weigh on the outlook?
Well, it does feed into just about everything, whether you're talking about transportation of services or goods, even if it isn't a direct component, energy matters. And, if you take a look at where we are now in the earnings season, about to enter the pre-announcement season, I think that's noteworthy, particularly in the discussion you just had about airlines. We're seeing some of the formerly healthy service sector of the economy begin to show some signs of weakness. Airlines are an example. American cut its third quarter guidance because of those higher fuel prices, but we're also hearing about weaker demand as this post-pandemic surge in travel starts to slow. In fact, I think Spirit Airlines talked about steep discounts in travel booked in the second half of Q3 ahead of the Thanksgiving holiday as that binge begins to slow. Student loan repayments come back, tighter credit from businesses, and of course, higher gasoline payments. Now, airlines are a tiny part of the overall market, but the read across to other consumer businesses and companies with oil as a big cost is important as we move through the next couple of weeks here in this pre-announcement season. Maybe more confessions could weigh on the market.
So, Jeffrey, what do you think the potential fallout then looks like?
So I think as we look through the next couple of weeks, I think there's a potential for some higher volatility here. The earnings picture isn't likely to improve very much. I think what we're seeing is broader weakness. Sure, the retail sector is still doing okay, construction's okay, but manufacturing remains mired in a recession, and the service sector is slowing. I'd also mention there are things like extreme weather weighing on the markets, and I don't just mean the hurricane moving up the East Coast. I mean the Panama Canal, which is really being impacted by a drought. We're seeing fewer ships and smaller ships being able to transverse the Panama Canal. That's 40% of U.S. Imports exports traveling through there. There could be bottlenecks, maybe supply chain issues as we look to this fall and into the winter, maybe holiday shopping season. So I'm worried about a number of these factors snowballing into maybe a more negative outlook and rocking the VIX out of this very calm level below 13 it's in now.
We're looking at a big debut today with chip designer ARM debuting in the markets, getting a big pop, at least in its initial day. The expectation has sort of been that any kind of success coming through from ARM's public listing could unlock a lot of other IPOs with companies that have been waiting in the wings. What do you think it means for market sentiment?
Well, there's certainly a lot of companies waiting in the wings, as you said. We are in a IPO recession. In fact, if you look at the last several months, we haven't seen IPO volumes this low since 2008 and 2009 as we were moving through the great financial crisis. So the fact that ARM is able to come to market is encouraging, but look, it's AI, right? The market's obsessed with AI. So I think it's a bit of an outlier and not really a sign that there's a return of IPOs that's going to benefit investment banks or a sign of renewed investor enthusiasm in the markets. I think this is more specific to that AI market that we know has been just part of a real mania this year.
Jeffrey, do you think it could boost some of those AI names, some of the names that had been leading the market here since the start of the year?
I mean, I'm not sure what can get in their way. They've been so strong. I'm increasingly concerned that all of the market's gains, I think the S&P 500 X, the Magnificent Seven of AI stocks, is only up 2% this year. So it really is everything that's pulling the market higher this year. So were something to get in the way, that would certainly cause the overall market to pull back steeply. But there still seems to be a lot of enthusiasm in the AI space, and we've barely even started to see investment heat up there from a business perspective, meaning the OPEX and CAPEX into that space.
Obviously, you don't want to make up too much of one day, but is that what you think is happening with ARM, or is it about an appetite in the market for, companies to go public? Because there's been concern about these high growth companies, sort of coming to market without the proper fundamentals. ARM is a different story, but I wonder if you think at least the initial pop we're seeing today really is about AI more than the sentiment around IPOs.
I think it's more about AI just because we're not in an easy money environment where you would see a sudden flood of businesses come to market. The Fed and other central banks have been tightening for a while. The environment is tighter. And so as a result of that, companies coming to raise capital in the markets, whether a fixed income offering or through the IPO market, it's going to be a bit more selective and probably will be a bit more selective for a while as long as rates remain where they are. As the ECB said today, they expect to keep them there for quite some time. And that's probably true for the Fed also. So in that tight environment, I wouldn't expect a flood of IPOs. I think this is a more unique environment tied to the AI mania.
Jeffrey, stocks are higher today as we head into the close. Investors weighing the readings that we got on retail sales and also wholesale price on inflation data. Overall, though, the markets have been fairly quiet in the last couple of months. You pointing out in your notes that stocks have not moved more than 2% up or down since June 2nd. What's it going to take in order to break out from this current range?
Well, I do think it could be maybe some pre-announcements, as I hinted at. I mean, I think the energy costs rising is a problem. I think the slowdown, the sharp slowdown in the service sector, the PMI for the service sector globally came in at 51.1 in its latest reading. That's down from, I think it was 54, 55, 56 back at the end of June. So at the end of the second quarter, that's a big decline in the sentiment by business leaders on their operations in the service space. Remember, the services make up more of earnings than manufacturing does for the S&P 500 and many other benchmarks. So that's deteriorating fairly rapidly. That could impact the guidance outlook. And then the supply chain issues I mentioned with the El Nino, the Panama Canal, other factors being affected. There are rivers in Europe where you just can't get barges through. You can't cool nuclear reactors because the water's too warm. A lot of factors taking place here that I think could shock the market out of its low volatility regime. But that said, the job market remains fairly resilient, and that seems to be the thing backing the stronger consumer numbers and the sentiment overall in the markets.
So, Jeffrey, what does that mean for your portfolio? Are you kind of staying put in your positions right now, or are you starting to maybe increase exposure in certain sectors and into expectation of more volatility?
Yeah, I am. I'm getting more concerned about more volatility. So I want to focus on stocks that have low price to earnings ratio or low price to cash flow ratios. Companies that are doing well right now, that have a decent amount of cash on their balance sheets, are coming in the door. So I call those short duration stocks. And I'm finding more of those outside the U.S. than inside. In fact, the equal weighted benchmark for the EFI index is outperforming the S&P 500 this year by a wide margin. I think most people don't realize that. They think the U.S. is crushing international stocks in every sector. But in fact, 9 of the 11 sectors, international stocks are outperforming this year. And so I would look outside the U.S. in those cash-rich part of the markets in order to build positions in portfolios, specifically financials and industrials outside the U.S.
Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Always good to get your takes. Appreciate the time.
Thanks for having me.
Well, coming up, our very own Jen Schomburger is on Capitol Hill speaking with Grayscale CEO Michael Sonnenschein for an exclusive interview. What's the latest on the fight for a spot Bitcoin ETF? That conversation is coming up on the other side.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger here on Capitol Hill, where crypto executives continue to push lawmakers for new rules of the road. Joining me here in an exclusive interview is Grayscale CEO Michael Sonnenschein. Michael, it's great to see you. Thanks so much for joining me.
It's great to be here. Thanks for having me.
So you just wrapped up meetings with lawmakers on both the Senate and the House sides. What are you hearing when it comes to crypto legislation?
Well, as an organization that has been coming down to Washington for many, many years at this point, I have to say we are simply encouraged. The work that has been done, even just over the last 12 months, has been really, really groundbreaking. We certainly applaud the work of Chairman McHenry, Congressman Hill, and certainly Senators Lummis and Gillibrand as we think about the bills that have been put forward and have come off of committee and are now going to the floor for, further vote later on this fall. I think that we have to remember that now more than ever, crypto in Washington has become a nonpartisan issue, and that members' understanding of these issues are more important than ever, and they realize that crypto is here to stay.
You mentioned the House Financial Services Committee passed legislation this summer for the first ever crypto framework, as well as for stable coins. Were you able to chat with Chair McHenry or other members of the House? What are the prospects for this on the House floor this fall?
Well, I think many of the folks that have been involved in drafting that legislation and those that have voted for it are really hoping to build on that momentum that now that Congress is coming back into session, that they can re-engage on these topics and get broader member support for it. I do think if we look ahead on the calendar with not only an upcoming presidential election and a variety of other catalysts, now more than ever really is the time for members to be engaging on this issue because, again, their underlying constituents are involved in the crypto space, and it's important that we continue to create financial and regulatory frameworks around it.
All right, so that's the House. What about the Senate side? We know that Senators Lummis and Gillibrand have a proposal that they have retooled after FTX. What are you hearing from them? What are you hearing for the prospects in the Senate? And by the way, would the Senate even consider the House's proposal?
I have to say, again, it's a tone of optimism, right? Having this type of momentum around these bills and the frameworks that they provide, these are the types of engagement that we're seeing from members like we've actually never seen before. Crypto is becoming an increasingly part of the demographics that support these sitting members. And as we think about not only the upcoming election, but also where these bills stand today, it's really, really important they continue to push forward on getting as much momentum around them as possible.
Will we see anything passed by the end of this year, you think?
I'm optimistic that we absolutely could. If any Congress to date could do it, it certainly could be this Congress.
All right, switching gears slightly, SEC Chair Gary Gensler testified before the Senate Banking Committee earlier this week, and he was asked about your court ruling. The DC Appeals Court basically said that the SEC was wrong to reject your Bitcoin spot ETF. Chair Gensler says he's reviewing the case. He's waiting for recommendations from staff. What are you hearing from the SEC? Has the SEC come back to you at all?
Well, so today is actually day 16 of a 45-day process where we actually have to follow the federal rules of appellate procedure. During this time, the SEC could request a rehearing of the case, and so it's important that we follow the rules during this 45-day period. Ultimately, to your exact point, the court order did in fact vacate the SEC's denial order for the Grayscale Bitcoin Trust application to convert to an ETF, and so we really are looking forward to a constructive dialogue like we've always had with the SEC to really pursue next steps for the ETF conversion as soon as possible and as expeditiously as possible.
Do you expect there'll be some sort of discussion, or do you think that the SEC will just try to appeal what was sent down?
It's really hard to say. During this 45-day period, we have to be patient. We have to wait for the process to play out. But of course, we do look forward to engaging with the SEC at the appropriate time.
Earlier today, Senator Brown, chair of the Senate Banking Committee, sent a letter to Treasury Secretary Janet Yellen and SEC Chair Gary Gensler, basically asking these agencies for more disclosure around crypto to better protect consumers. Your thoughts on that? Interesting to see this coming from the Senate Banking Committee Chair.
It is. I have to say, as an organization that dating back 10 years to our founding has always prided ourselves on building investment products that are really built upon full and fair disclosures, that it certainly resonates with us that anytime we're bringing investors into investment vehicles, that we're pursuing the fullest and fairest disclosures possible. And that really, for us is the reason why we had the lawsuit against the SEC to begin with. For GBTC, the largest Bitcoin fund in the world, we've been litigating to try and convert it to an ETF because bringing it into that ETF wrapper would give investors added protections, added disclosures, added reporting obligations. Those are the types of benefits that we want investors to have and ones that we're really supportive of.
Switching gears again slightly, the IMF and the G20 last week, at their meetings in New Delhi, were really pushing forth a global crypto framework, especially around DeFi. They're very concerned that cryptocurrencies pose a risk to the global economy. They are hoping and pushing for members to adopt these principles. Your thoughts on that, and whether we could see U.S. regulators, U.S. lawmakers adopt those principles?
Well, I have to, take a step back and look at crypto and its market cap as compared to the broader financial services landscape. It's still quite small. It's still in its infancy. And so to be getting that level of recognition from, the G20, from the IMF, actually is a really big milestone. It starts the conversation. That's a theme that's been really consistent, certainly here in the U.S. with members here on both the House and the Senate, who are really engaging with, industry leaders like us as a resource for them. And I think the same is true if you look at the G20 or the IMF. That being said, there's a real opportunity for the U.S. to really assert its dominance as really the center of the capital markets ecosystem on a global level and ensure that we are putting in place the right frameworks, not only just for investor protections, but also that crypto as an asset class can flourish here in the U.S. and not shut the door on innovation.
Michael, thank you so much for your insight. I so appreciate it.
Thank you.
Akiko, I'll send it back to you into New York.
All right, Yahoo Finance's Jen Schomburger there in Washington, D.C. with Michael Sonnenschein. Thanks so much for that. With nearly 3/4 of 2023 in the bag, mega caps still dominate index returns of this year. Unlike early in the pandemic, the stock giants are trouncing unprofitable names. Let's head over to the New York Stock Exchange. We've got Yahoo Finance's Jared Blickery on the floor with more. Jared.
Sometimes it's not the biggest news, but your eyes do open when you see the charts. Let's take a look at the Wi-Fi Interactive. It's been a couple days now since I've talked about mega caps. The last was Apple, but today I'm focusing on something else. And let's get a chart here. This is by T.S. Lombard. This is the returns going back to 2020, so just before the pandemic, of the mega caps in purple here, which I'm tracing out, and then the non-profitable tech, and that's going to include a lot of the disruption companies that you see as ARC components. And we saw that gigantic rise in early 2021, very, very minuscule rise when you compare what's happened this year to what happened in 2020 and 2021, and especially with respect to the mega caps. But I don't think I have to remind people of that who look at their 401ks or their statements regularly. You know what? This just landed on the 10-year T-note yield for some reason, and I'm going to go with it. Yields have been up overall. You can see kind of sideways over the last month or so, but they are up today at the upper end of that range. That usually weighs on growth stocks. That usually weighs on the mega caps, but not today. You know, another thing that also tends to weigh on some stocks, the US dollar, when that rises, it is at new multi-month highs here, if not year highs, but that's not weighing on stocks either. And then you take a look at the VIX. Let's get that up. That is printing just about new lows for the year. Here's a look at a year-to-date chart. It's hard to see down there, but very much by the lows of the year there. And this in itself is a very low volatility regime. So I think today we're just seeing a case of everything kind of moving up, almost everything, with the exception for the most part tech. NVIDIA, you can see here, is flashing red and green. NVIDIA spent most of the day in the, well, actually about most of the afternoon in the red, climbing back in the green right now. But I want to compare some of the mega caps against each other. Here's a 3-month chart of NVIDIA. Hasn't really done much since its earning date. That big red candle up there, that was its earnings. Perfectly normal to consolidate after a big move up like that, so I'm not going to ascribe any importance to it. But you compare that with Apple. Apple is at the bottom end of its range, having problems sustaining its revenue growth. Two stocks which have really picked up and caught my eye today, though, are Alphabet and Amazon. Here's that same 3-month chart, and you can see Amazon, kind of the opposite of Apple. It is at that 52-week high right there. Same thing for Alphabet. You can see climbing to the top of its range there. So even among the mega caps which have dominated led the indices this year, we are seeing a little bit of bifurcation. So it'd be interesting to see how this all evolves. But for today, most things are going up.
And that's a good thing for a lot of investors out there. Right, Jared? Thanks.
Thanks.
Well, the clock is ticking, and a UAW strike is looking more and more likely starting at midnight tonight. We are going to be speaking with Bob Nardelli, former Chrysler CEO and former Home Depot CEO, when we come back. Detroit's big three automakers have just a few hours to solidify a deal with United Auto Workers before the union executes its targeted strike plan. UAW President Shawn Fain saying that the union and automakers are still quite far apart in talks. Ford's CEO Jim Farley saying that the company has made its most generous offer in 80 years and has received, quote, no genuine counteroffer on its proposals from the union. So where do we go from here? Well, our next guest may have an idea given his experience in the auto industry. We want to bring in Bob Nardelli. He's the former CEO of Chrysler, also the former CEO of Home Depot. Bob, it's good to see you. So given your experience, I know you've been in similar talks in the past when you were at Chrysler. What's happening right now in the 11th hour of negotiations?
Yeah, well, we're certainly, first of all, thanks for having me on. And we're down to the final hours here. And what happens is typically, there's a big ask and then there's rational discussions that hopefully prevail and we don't have a strike. As you know, no one wins in a strike, particularly if it's prolonged. You never make up the wages that you lost. You never make up the customers that you may have lost, and the impact could be devastating. Now, look, I understand the importance of making a living given that we're dealing with this inflationary period here. But this just continues to inflate inflation. We saw the head of the Teamsters said it was probably the most lavish settlement that he's ever sent. And Jim Farley just mentioned, this would be the biggest proposal offered in 80 years. We now see that the average UPS driver is making about $170,000 a year. That's number one. The American Airlines, another 30-40% increase, over $9 billion in wages. We saw the dock employees out on the West Coast, again, another 30 to 40% wage increase. So the momentum is certainly swinging that way. And you would understand the importance of having financial income for your family during this inflationary period that we're all challenged with in many, many ways. So I hope cool heads prevail. They started at 46%. They went to 40, now somewhere between 36 and 38. But they're looking for, 32-hour work week, 32 hour with a 40-hour work week pay. I don't know how you build cars without employees in the factories. They want to restore pension. Now, back in 07, 8, and 9, when we were living through that period of the financial meltdown, we had to make some very aggressive and draconian negotiations to keep the big three alive at that point. The difference from then to now is there's a lot of optionality out there. If the big three goes on strike, then we'll see, whether it's Toyota, whether it's BMW, Hyundai, et cetera, there are options now for cars. The average age of the car park out there, the installed base, is 12.2 years. So if you lose that customer, you could lose him for over 12 years before he or she would come back and purchase another car. And one of the benefits I had at Chrysler is I had Ron Littlefinger, who was an unbelievably supportive, open-minded individual of what we had to do to save the big three back in 07, 8, and 9.
Bob, you mentioned concerns around those higher costs, but there's a larger issue you could argue that's at hand right now is this transformation that's happening from ICE cars to EV cars. It seems as though when you think about the main concern, or one of the large concerns from UAW coming, that their jobs, in fact, will be secured moving forward. The fact that you don't require as many workers to build an EV car, although you could argue there's battery jobs down the line as well. I'm curious how you put yourself in the seat of these CEOs. How do you weigh these two issues? On the one hand, you've got a company that needs to invest significantly to make this rapid transition, and yet you've also got union workers who are saying we need to be part of that future.
Yeah. So a couple of points there that you mentioned. First of all, I don't believe that the transformation to EV will happen at the projected rate that this administration may want. I lived through this in 07 and 08 with Obama and the CAFE standards. And quite honestly, they had to take an off ramp because the consumer isn't going to buy what you just happen to produce. After 52 years, you got to produce what the consumer wants. And right now, range anxiety has moved to charging anxiety. So that's not going to happen as quickly as the projections are out there, point one. Point two, you mentioned Jim Farley. They've lost over $6 billion now in the last couple of years. And he had to get a $9.2 billion grant to support battery operations to be able to manufacture batteries. So this is going to be a major financial challenge as we make this transition from traditional ICE engines, where you could stop at any filling station and refill and move out in minutes, as opposed to charging for hours. You saw the Secretary of Energy had a problem. You saw Jim Farley was quite candid and open about the challenges he had when he was on his road trip with the 150 Lightning. So I think that's not going to happen at the rate it is today. And yes, there has to be a transformation. And we go through this all the time with the repositioning of labor, but just trying to, basically do a land grab during this period of time. And again, I understand the importance of financial, needs for the family, but some of these things are possibly overreaching. And again, if there's a strike, my numbers were something like 10 to 1. So for every one UAW employees, let's say it's 150,000, 10 to 1, that means 1.5 million employees potentially could be idle. And the thing we learned in 07, 8, and 9 is that even if you single one of the big three out, basically that supplier serves all three. and you will cripple the ability to maintain supply. So Ratner learned that, Summers learned that, Obama learned that, and that's why they had to try and do whatever they could to keep all three of us alive during that period of time.
Bob, when you talk about some of the risks here from this potential strike, the inflationary pressures, what we could potentially see, how much of that do you think is going to be passed down to the consumer, and what is the end result of that?
100%. I deal with Fortune 500 companies. I deal with a lot of mid-market companies. And quite honestly, if you hesitate from a cost increase from a supplier to passing it on, you'll never make it up. And a lot of the companies that have tried not to do that are suffering today. They're suffering today. As the administration is creating this inflation and the feds are trying to stomp it out, what's happening is they're crushing middle market companies. Why do I say that? Well, some that I deal with, we were doing $2 million a year in interest rate, and now it's up to $14 million on interest rate due to inflation in the interest rate. And therefore, 100% of free cash flow is now going just to pay the interest. So it's much like what we see with the national debt. You know, our interest rates are going to be greater than the defense budget that we have in place. So, yeah, you have to pass this cost on. If there's an 18% price or cost increase in wages with the settlement with the UAW, that's going to be passed on as soon as they can do it to the consumer. That's you and I that are trying to buy these vehicles. And what'll happen, again, the big winners back in 07, 8, and 9 were the auto suppliers and the mechanic shops. Their stock, if you look at O'Reilly and some of the others, have gone up like 700% because people are keeping their cars in the car park. It went from 11.6 years to 12.2 now. And so that's one of the things that we'll see. And once we cripple some of these tier 2, 3, 4 suppliers, it'll play heck to get them back up and running. So the layoffs will cascade down and will have significant impacts on this industry and the economy going forward. It's unfortunate, and I understand it, but that's what will happen.
All right, well, we will see whether or not a deal can be reached before midnight tonight. Bob, thanks so much for your insight. Bob Nardelli, former Chrysler CEO and former CEO of Home Depot.
Thank you very much. Thank you.
The August CPI report showed the Fed's fight against inflation certainly isn't over, with consumer prices rising 3.7% year on year. Gas prices are largely behind that jump, with prices spiking nearly 11%. Let's bring in Yahoo Finance's Josh Schaefer to discuss more. I guess the counter argument to that, Josh, would be, well, the Fed looks at core, not necessarily the headline number.
The Fed does look at core, Kiko, and so that's normally what we focus on. But I've been sort of struck by the gas price increase and what that means for headlines. So what I'm sitting next to right now is that headline inflation number, the overall CPI number, where you can see we had our nice little uptick over the last 2 months, coming up to 3.7% over the last month. And then when you take a look at gas prices, you can, or oil prices rather, and how that translates to gas prices, you can see a similar uptick and what that means. And so what we've been looking at is what gas prices actually mean for the fight against inflation and what economists have to say about that. So Morgan Stanley said this could actually be a positive overall in the fight against inflation, specifically for the Fed. And here's why. So if you take a look at how gas prices pass through core CPI versus overall CPI, the purple lines we have here is headline CPI. So gas prices over the next several months are expected to have a pretty big impact on overall CPI. Could jump as much as 35 basis points, 0.35%. But when you take a look at the impact it has on core CPI, 2 months after we see that oil price peak, it will have about a 5 basis point impact. Really, that's not that big of an impact when we think about the Fed looking at core. But why does it matter? Why is it helpful? Well, Americans spend a lot of money on gas. And one thing Jerome Powell has mentioned is we're waiting for the resilient consumer, that resilient U.S. economy, to maybe just slow down a little bit. It takes about 3 to 8 months for higher gas prices to eventually weigh on that American consumer, take part of the wallet share, and actually slow things down maybe a little bit for the economy. So economists saying right now, high gas prices might be one of the many things. We're also talking about student loans. We're talking about the potential auto strike. But you can add high gas prices to one of the things that might actually be helping the Fed in terms of slowing down the economy and not having to raise interest rates another time.
And we'll see. You would think, obviously, that it would be one of the first things to affect some of those consumer spending patterns. All right, Josh, thanks. Well, coming up, the closing.
Well, coming up, we've got the closing bell on Wall Street. We're going to check in on the latest market moves and the top trending tickers. Stay tuned.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
There's the closing bell on Wall Street as we wrap up what has been a solid day here for the market. Some rallying action with the Dow closing up off the highs of the day, but still up just above 300 points. The S&P up nearly 1%, as well as the Nasdaq. All three of the major averages closing off their highs of the day. This market check sponsored by Tasty Trade. Taking a look at the sector action that we saw this afternoon, some of the strength there from ARM's IPO is evident when you take a look at the tech sector among the outperformers. We also have materials, real estate, consumer discretionary, and communication services among the leaders in today's trading action. But Akiko, it's all about ARM and that strong IPO that we saw today.
Yeah, and that is one of the stocks we're focused on at this hour, the newest addition to the Nasdaq. You saw ARM getting a big pop today in its debut. The chip design company controlled by SoftBank jumped more than 10% in its first day of trading. The company is valued at nearly $60 billion. Shauna, that's a big boost for SoftBank when you consider they bought that remaining 25% stake recently from the Vision Fund at a valuation of roughly $64 billion. They're cashing in roughly $5 billion from this IPO. But, you know, interesting take from Jeffrey Kleintop earlier, because so much of the conversation around ARM has been a successful debut will unlock sort of the pipeline for IPOs. He seemed to think this was more about an AI play. This doesn't necessarily mean that there's a lot of enthusiasm for IPOs, at least not on the level that we've seen in past years.
Yeah, we'll see. Instacart, which we're expecting next week, is also going to give us another look just at investor appetite for IPOs. If it does, in fact, go beyond some of the AI plays in the AI sector that Jeffrey Kleintop thinks is one of the reasons why we saw such a strong debut here for ARM, with the stock closing up nearly 25%. But we know that AI is a pretty key market here for ARM, just the exposure to AI. The company has been playing up that, at least in terms of the roadshow and trying to get investors, institutional investors, excited about the name. But when you take a look at the valuation right now, the fact that we did see such a pop in its public debut, I think some people are starting to question, or have been questioning a little bit, given the slowing rate of growth that we have seen, given the 1% revenue drop that we've seen in ARM in its most recent quarter. So we'll see whether or not some of the enthusiasm sticks around here beyond the first day of trading. Let's take a look at Delta, because shares closing the day off just about 0.5%. Now, the airline cutting its third quarter profit forecast, citing increased fuel expenses because of supply cuts by Saudi Arabia and Russia. Delta is also overhauling its loyalty program. Passengers will no longer earn status based on the number of miles they fly, but they will earn their status based on the amount of money they spend with the airline. The airline also putting a cap on how many times Amex Platinum and Platinum Business card holders can visit their Sky Clubs per year. Basic economy ticket holders will not be allowed in their lounges, regardless if they carry any premium card. But Kiko, let's talk about the profit cut there, because this has certainly been a trend amongst the airlines. Delta joining some of their peers out there. We heard from American earlier this week, Southwest, Frontier, Spirit, among the names here, warning that higher fuel prices are going to impact their company, at least in the short term. To what degree, though, is the question.
Yeah, and that's still to be determined. You know, this also coming at a time when we have seen some signs of slowing here, looking into this next travel wave going into the holiday season. You know, how much are Americans willing to shell out on travel at a time of higher costs? You mentioned some of the other airlines where we saw their forecast lowered. American Airlines, we saw that stock 4-month low yesterday on the back of the company lowering its forecast, higher fuel prices. They also talked about cost tied to new labor agreements. Spirit, also another one. But Shauna, you know, while we are focused on higher fuel costs and the impact, I would argue the announcement coming on mileage is going to get a lot of people really upset, because, as you know, there's been a debate for some time about where those points should be earned. We know airlines have been moving in the direction of the cost of the ticket as opposed to the miles traveled. But I know a lot of people who rake in a lot of miles every year are saying, well, no, wait a second, that should count for something.
Yeah, I would be pretty upset if I was one of those people. Delta is not my airline, but if it was, I would be upset by this change.
Yes, I do keep loyalty points with Delta. But moving on here to another stock we're watching today, that is Yum China. That stock up more than 5%. The company that operates Pizza Hut, KFC, and Taco Bell restaurants in China held its 2023 Investor Day and outlined its RGM model, also known as resilience, growth, and moat. The plans include leveraging flexible store formats and strategically partnering with franchises to expand into more locations. This is a pretty aggressive plan when you look at the numbers that have been put out by Yum China. They say they plan to build a 20,000 store network in the country by 2026. They're at 13,600 now. And of course, you know, when you think about the Chinese market specifically, we have seen a slowdown in the economic growth there, concerns around to what extent consumers are willing to spend. So, you know, that's adding to the pop in the stock, the fact that the company seems fairly optimistic moving forward.
The company's optimistic. The company's pretty confident, at least for now, that they are going to be able to reach some of those growth targets here over the next couple of years. Now, fast food has been one of the very few bright spots when we take a look at China, where consumers have continued to spend some of their money. But given the fact that we have seen such a sluggish recovery there, given the fact that we don't really see any real catalyst, at least in the short term, that is a risk here for Yum China, given the fact that they do have very lofty and very aggressive expansion targets here over the next couple of years. Whether or not they're able to weather some of those challenges over the next couple of years, we'll find out pretty quickly. But despite all that, again, Yum China aggressively expanding the number of stores, planning to build a 20,000 store network in the country by 2026. Walt Disney has reportedly had exploratory talks about selling off ABC network and TV stations to local broadcaster Nexstar Media Group. That's according to reports from Bloomberg. Yahoo Finance reporter Alexandra Canal is here to tell us more. Allie.
Yeah, so this is a report from Bloomberg, as you just mentioned, the stock closing up more than 1% on the heels of this news. Byron Allen, another media mogul out there, he has also reportedly been in talks with Disney. But I do want to emphasize that these are early stage talks. We don't even have a valuation of what the ABC network or television stations would be worth. Disney did not immediately respond to my request for comment, but it does demonstrate how serious Bob Iger has been when he talks about taking this company to the next level. He's mentioned quite a few times how linear assets, they're no longer core to the company's business. But I do think spinning them off is going to be more complicated than we think. Linear is profitable. It's a high margin business. ESPN, which really does seem to be the crown jewel of Disney at the moment, it does simulcast a lot of its programs on ABC. So how would that look with a potential sale? For a company like Nexstar, they aren't immune to M&A. They actually bought a majority stake of the CW from Warner Brothers Discovery and Paramount last year. They have actively expressed that they would be interested in buying off some of those assets from Disney, but it does make you think of what a future Disney could look like. Clearly, Bob Iger is very focused on direct-to-consumer, on streaming, on over the top. But speaking of streaming, we just got a headline crossed from Bloomberg that said they plan to cut their target for Disney Plus streaming subscribers. We'll wait to hear a little bit more on that reporting. But to me, that doesn't sound so good, especially when you're a company that's giving up so much on the linear side to try and focus on the streaming business. So just another headwind for Disney, as it's been battling quite a few of those over the past few months.
Yeah, it could be problematic here from Disney if, in fact, this report here from Bloomberg is right. Allie, you're also watching another story here, and that's AMC selling 40 million shares, receiving over $325 million in new equity capital. What does this mean for AMC as a company does all it can to really improve the fundamentals potentially here of its business?
Yeah, and I was just looking up the stock price there because interestingly, it did close down 1% when it was up as much as 9% earlier today on the heels of that report. Not report, I should say, rather the fact that they have raised a significant amount of capital, over $325 million through that stock conversion plan. The stock has been very volatile as investors have become pretty worried that would lead to more dilution over time. But we consistently heard from CEO Adam Aron, who said that this was very imperative for the company to survive, to shore up its balance sheet, to have those cash reserves. And we're entering a period of time in the fall where there's not a lot of blockbusters. We don't have that big Barbie movie, that Oppenheimer movie. We do have the Taylor Swift Eras Tour movie, which should be a tailwind for AMC. But in the background, you have the Hollywood writer's strike, which means we likely will see more blockbuster delays moving forward. So something like this is certainly important for a company like AMC. But again, shares closing down more than 1%, giving up a lot of those gains from earlier in the session.
All right, Allie Canal, thanks.
We are watching shares of Adobe right now after the company released its latest quarterly results. We are seeing that stock down just slightly despite a beat on the top and bottom lines. Let's run you through some of the numbers here. In terms of revenue, coming in at $4.89 billion in the third quarter. Looking at earnings, let's do the numbers there. At $4.09 versus a $3.98. that was expected. The company specifically focused on their offerings on generative AI, with CEO Shantanu Narayan saying that we are unleashing a new era of AI-enhanced creativity around the world with innovations across our product portfolio. Of course, a number of those offerings were announced yesterday. That's going to be one of the questions on the earnings call in terms of the pricing strategy for Adobe. But business segment highlights, looking through those numbers there, the digital media segment revenue came in at $3.59 billion. New digital media, we're talking about annualized recurring revenue. They're coming at $464 million. And looking at the stock again, down just slightly. But again, Shana, the discussion here is going to be about how those offerings, which Adobe has been quite aggressive about on generative AI, how that's going to bring in the revenue for the company and how they're looking at pricing. We keep saying the show me quarter, but this company no different.
Yeah, it's certainly going to be one of the focuses here on this call when we talk about the ramp up potentially that the company is doing with the AI generative related products, what that means ultimately for the business in the short term because of that cost, but in the long term, given the fact that it could potentially really boost their business here. But a strong quarter, at least it looks like on the surface here for Adobe, with a beat on both the top and bottom lines. Revenue growth was up 10% on a year-over-year basis. Subscription growth was also up 12% from a year ago. All right, well, coming up, Brian Sazzi sat down with Salesforce CFO Amy Weaver at the tech giant's annual conference, Dreamforce. They talked all things AI. That's next on Yahoo Finance.
All right, Yahoo Finance is at Dreamforce, still talking about the future of AI and really the future of Salesforce. Let's bring in right now Amy Weaver, Salesforce CFO. Thanks for having us at Dreamforce. We appreciate it.
Oh, Brian, so glad you're here. You can just see all of the energy, all of the excitement. We have trailblazers from 90 countries from around the world now.
This place is packed. It's always one of our favorite events. How does the CFO of Salesforce spend their time at an event like this?
Well, first is spending time with our customers. You know, our customers are really here for their focus on AI. More than any other year, I think that there's a unified focus, and it's all about artificial intelligence. You know, the keynote today, we highlighted new AI throughout all of our products, and it showcased some incredible companies and what they're doing.
How does this AI, we're seeing it, I've certainly seen it at the event, talking to people in the product installations and the exhibitions, how does this change the financials of a company like Salesforce?
You know, it has the possibility to change every company and every company's financials. We're really at the beginning of the AI revolution. Right now we're focused on how we can best serve our customers, how we can educate them, how we can really get them ready for what's coming with AI.
We've seen a lot of companies, I think, shock investors on how much business and book of business they're building from AI. Yes. How should investors think about the trajectory of your business in 2024?
You know, in FY24, we just had a fantastic quarter. I'm sure you saw we hit it out of the park. Revenue, operating margin, cash flow. We were also able to raise on all of those points in our guidance. So we've raised our revenue for the year, raised our margin, raised our cash flow. Now, artificial intelligence, we're excited about that, but as I said on the earnings call, it's not part of our guide for this year. That's going to be more of a future event.
Of course, you sit on that McDonald's board of directors as well. What's your view on the economy headed into next year, as seen through the prism from a company like that, but also big tech budgets?
You know, it's really interesting for Salesforce. For about the last year, we have seen a more measured buying environment. And I think it's true across the tech industry. There have been elongated sales cycles, deal compression, additional approvals, and we're continuing to see that. But looking to the future, you can feel the buzz, you can feel the excitement. I think we've got good times ahead.
You had I think it was you that made a really important point on the earnings call, and the earnings call just happened, just to be very clear. You said 30% operating margins are the floor for your business, then what's the ceiling? Maybe you're trying to get a little guidance. I mean, you're the CFO of Salesforce, I have to ask these things.
Well, going back, you know, we've had incredible operating margin this year. For the second quarter in a row, we increased our operating margin more than 1,000 basis points year on year. Pretty much unheard of for a company. I'm really excited about that. I was able to raise our guidance to 30% for the fiscal year, which is really a milestone amount for the company. And I have commented several times, I think 30%, we need to treat that as the floor, not the ceiling.
So how are you driving these operating margins? I know you've had to make some tough decisions on the business. Where are the biggest gains coming from?
You know, right now the gains are coming primarily from the decisions we made last January. We made some tough decisions around headcount, tough decisions about real estate, but we're also bringing a new discipline around spending, and you're seeing that pay off in our margins.
Is Salesforce being reborn? There's a different vibe to this conference, and I told my team back at home, I don't know what it is. I can't put my fingers on it, but do you feel that? Do you see it?
I do. Salesforce and Dreamforce, it has all the same energy, all the same excitement, but there's a new maturity. I think there's maturity in our processes, there's a maturity in our product, there's a real sophistication in terms of what we're doing with AI. And I think you can feel our customers really leaning into that.
What has it been like leading Salesforce really through so much transformation of the past year? You've really dealt with situations that I have not experienced from someone who covers Salesforce, and you have not experienced the activists and headcount reductions, and what has it been like for you?
We have had quite a year, but I'm incredibly proud of the company. Our employees have risen to the occasion, they have rallied, and there is not one person at the company who has not been involved in this transformation and bringing us through this.
Mark and I, CEO Mark Benioff, co-founder, chairman, we talked about boomerang employees.
Yes.
People coming that used to work at Salesforce, they left for whatever reason, they're coming back to your company to, I guess, drive this AI revolution. How important have those employees been to this rebirth we're seeing in the company?
You know, we've had some incredible boomerang employees. Steve Fisher is a terrific example. He left back in 2014, went off to eBay, other experiences. He's come back and has been really instrumental in terms of our engineering and our artificial intelligence. We've had many others come back, and what I love is they know the company, and yet they've had these outside experiences, and it brings it all together. They hit the ground running. But I also want to give credit to our employees who have been here throughout. They are the engine at Salesforce, and they have brought us through this year.
Before I let you go, I mentioned to Mark too that all this AI, I would imagine you have to retrain workforces around the country to learn a lot of these new products, but I think it also starts in the schools. I was thinking back, I learned really no computer skills in school whatsoever. I think I started working on the Commodore, which is wild, like playing Pac-Man or some weird game, but how are people going to get the skills to put some of these new AI applications to work?
Well, I think it's a perfect question. Salesforce is incredibly dedicated to public education. Probably the most fun thing I have done at Salesforce or at Dreamforce is I went across the city yesterday to George Washington High School, where we announced another $20 million donation from Salesforce to public schools. And in this case, it was particularly for artificial intelligence. How do we get the technology? How do we get the skills in the hands of our students? And you're right, this is not something that we've dealt with before, but we need this. And it's not entirely altruistic from Salesforce. These are our future employees. We need these students to have the best skills, the best technology, and the best future.
So this money that you unveiled, these children are going to learn how to code, how to use AI?
Absolutely, and this was just a small part of the investment. Over the years, we've given $72 million to the San Francisco Unified School Board, $52 million to Oakland, and more around the world. But today, really focusing on that AI. And one thing that was really fun, we had the George Washington High School Robotics Club here for the keynote. They are going around now, they are hitting all the booths, they're hitting the different sessions, they are just going to be cutting edge. And about half of them were girls, and I was particularly thrilled to see that.
That is really cool to see. I will let you go. I know this Dreamforce is your event, you're very high demand. I also know you don't do a lot of interviews, so thank you for coming on Yahoo Finance. We greatly appreciate your time.
It was a pleasure, thank you.
Weaver, Salesforce CFO, we'll talk to you soon. Guys, back to you.
And our thanks to Brian Sazi for bringing us that interview from Dreamforce in San Francisco. Well, student loan payments are set to resume October 1st. The class of 2024 won't get the buffer that pandemic-era graduates received. Many of them will have to start making payments 6 months after graduation. According to a recent Handshake survey, nearly 60% of students expect to graduate with student debt. Of those respondents, nearly 70% say their loans will influence what job they take after graduation. Now, fortunately for them, more and more companies are taking this into consideration. As part of our week-long special Student Loan Smarter Strategies, we're going to be discussing how business plans to help student loan borrowers is Christine Cruz-Vergara, Handshake Chief Education Strategy Officer. It's good to talk to you today. Let's talk about how companies are thinking about this, first of all. It feels like this is becoming increasingly part of the benefits package. What are you hearing from companies on how they're structuring this with the understanding that employees coming in are shouldering that load?
Yeah, this is a really big concern. And for the graduating class, they want to know that they have employers that care holistically about what this is going to look like for them. So just in the past year, we have seen the number of companies that have mentioned student loan repayment double on Handshake. And that's going to go a long way to attracting a lot of the recent graduates into their companies.
Yeah, Christine, how much do you see this potentially influencing the job search? How much of a priority is it here for these recent graduates?
Well, financial stability is the primary factor that the class of 2024 is really looking at as they think about where they want to go, how they want to start their career. So student loan repayment is a big piece of that. As we know, many of the students that are graduating are going to have loans upwards of sometimes over $1,000 a month. For an entry-level grad, that's a huge chunk of their paycheck. And so this is going to be a really big piece that will factor into their decision-making. I think, again, you all mentioned at the beginning of the segment, 70% of those that are graduating with student loan debt say that this is going to influence the way that they think about their job choices and what companies they choose to go to.
So how are companies responding to this? I mean, is it structured similar to like a 401k where the companies are asking employees, look, how much is it that you have to pay? We can pay an X amount in relation to that.
It really varies company to company. So different organizations are structuring it differently. For some, it's about once you've given a certain number of years and investment in the company, they are willing to start paying a portion of your student loan. For others, it's if you've spent a certain amount of time, they'll help pay off whatever remaining debt you might have. For some, it's a little bit more like a matching, sort of like a 401k. So it really varies depending on the organization and the company.
Christine, the companies that are offering this, are you seeing any trends in terms of sectors, industries, some that are more likely to give this offering or have this offering versus others?
Sure. From our data, what we're seeing is actually that healthcare companies are rising to the top and mentioning student loan repayment more in their job descriptions. They come in at the very top of the list. You've got nonprofits that are coming in right after them. Government coming in third, financial services, not surprisingly, is fourth, and then education kind of rounding out the top five. So those are the 5 main industries that we're hearing from the most. Now, that being said, my own personal experience is actually working with Travelers Insurance back when I was actually working in higher education and supporting students in their career journey. They were very early to the game in offering something like student loan repayment as a way to make insurance a more attractive industry for a lot of early graduates. As you can imagine, most students don't graduate from school thinking, I really want to work in insurance. So we saw some early partners that were thinking about this a long time ago, and now they have a lot of other colleagues that are catching up to that game.
Christine, you mentioned that more and more companies are offering this benefit. I wonder how much of this is in response to what has been a tighter labor market, that employees have the leverage to ask for this. How much of this do you think is just kind of where the trend is going? This is going to become the norm, sort of like just getting health care.
I do think it's going to become the norm. I also think one of the things that employers are really wising up to is that Gen Z, the newest generation of workers that are coming into the workforce, they care a lot about well-being. They care a lot about sort of the holistic person that is coming to work. And I think the pandemic played a really big role in that. So what we're hearing from a lot of employers and from a lot of students are questions about mental health, about well-being, and student loan repayment is part of that conversation as they think about their financial well-being. So all of these types of benefits are becoming more the norm as a new generation comes into the workforce.
Christine, is this just being offered to entry-level positions, entry-level employees, or is this type of offering here available to maybe those who have been out of school for 5, 10, 15 years?
For most of the companies, it's for anyone that has student loan repayment. So it would work for older and more seasoned workers that have been there for a few years, in addition to the early talent that is coming in right now.
It's interesting to see more and more companies moving in this direction. Christine Cruz Vergara, Handshake Chief Education Strategy Officer. Good to talk to you today.
Thank you for having me.
Let's do a quick check of the markets, see where things settled. Sponsored by Tasty Trade. The Dow closing up 331 points, the biggest jump that we've seen for the Dow in just about a month. A strong public debut from ARM, really helping investor confidence here. The Dow closing higher for the first time that we've seen in 3 trading days. When you take a look at the outperformance that we saw in ARM priced at $51 a share, really popped above $60 a share in this session. So strong debut here from ARM, helping investor sentiment. Well, coming up, we are checking in on some of today's top trending stories. Allie Canal, Josh Schaefer standing by with what to watch. What do you have, guys?
Hi, Shauna. Well, it's almost 5 p.m., which means happy hour is right around the corner, but could it be the end of the post-work happy hour?
Well, I think maybe we should grab a beer early, and we're going to debate it next after this, because I'm still going to happy hour. I don't know about everyone else out there. Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Prosy Romanian. We're breaking down some of the trending stories we've had our eyes on today, guys, and I've had my eyes on the casino stocks taking a hit lower yesterday and still some issues today related to a cybersecurity issue. Now, we're mainly talking about MGM here, but Bloomberg also have reporting that Caesars had problems as well. MGM had issues with a cybersecurity attack for several days, impacting some of the casino some of the machines at the casino, like slot machines. And I think it brings up two interesting concerns when you think about it overall, would be, A, if my personal information is anywhere in any of these casinos, whether or not that's what the hackers are going for, you're going to be worried, right? Just as a general consumer, I think you're worried. But also interesting to see some of the tech at MGM's casinos shut down. The Wall Street Journal did a great story today sort of digging into what it's like right now in Vegas. And you have some people that went to Vegas to go gamble at an MGM casino, and then they either don't want to because they're not sure that they want to do it, or B, they've gone to machines and some of the machines are out of order right now. So you're seeing a little bit of two things at play. For me, I think most concerning is always my information getting out there, right?
Yeah, and you couldn't even use ATM machines, which if you're at a casino, you need the ATM to get the cash out. You got to go get more money so then you can give it to them. Exactly.
Yeah.
But then to your point, if you do put a debit card in there, could that potentially be exposed? It seems like a lot of these companies, but really the consumer is just so vulnerable. And I know, Josh, you were talking about how we were discussing before the segment started about how much we rely on our data being protected at the end of the day.
Pros, that's the example here to me. The scariest part of this is just like, you have no control over where any of your data is because I want to use Apple Pay everywhere I go. So my information's just out there. And if they get hacked, that's a big what am I going to do?
You know, I'm just sort of like concerned that Vegas casinos, like, this is an Ocean's 11 hacker. I mean, usually it's Fort Knox right over there, right? Money is number one. They are making sure no one's
Where's
ripped
George
off.
Clooney?
And you couldn't even check into your room. Cashiers are writing out checks for a penny. People are cashing out a penny on the floors. Absolute chaos, right? All intertwined. Your hotel card, your winnings, the MGM sports betting too, also got impacted. It's like, it's wild how this happened. And I can't believe it happened at a casino. Where is George Clooney and Brad Pitt and all these guys? Like, where are they? What's going on behind the scenes, right? You know? That's what
I completely agree. Total Ocean's 11.
It's crazy, yeah.
They'll make a movie about this one day for sure.
Oh, really?
I think so.
Maybe we'll be featured in it. They'll play us in the beginning.
All right, well, another story that I'm watching is Medallion members in uproar, right? Delta Sky Miles. I'm a member of Delta Sky Miles.
Uh-oh.
They're making it hard. I'm going hard here. They're making it harder to get status now, right? So in order to get even silver, gold, and let alone diamond, miles don't matter. It's all about cash, how much money you're spending, and then here's the kicker, man. Lounge access. They're restricting lounge access. People who own Delta, the Delta Reserve Amex card and the regular Platinum Amex card, Delta Reserve only 10 visits a year. Platinum, Amex Platinum, 6 visits a year. 6? What? That's like, that's
if
crazy.
The viewers at home can't tell, Pros, what lounge do you use when you go to the airport?
I go to the Delta Lounge.
Okay.
But one other thing, if you buy a basic fare, even with Platinum Amex and Amex card, cannot enter the lounge.
Wow,
Uproar.
and my mother loves going to an airport lounge.
Yeah.
That is the reason that she has an American Express. So,
Platinum.
and that's,
Platinum.
the Platinum. And a lot of people do it for that reason, for the convenience of it all, and for the miles and the points and this and that. It does, and I bet you consumers are not going to be.
You know what's probably
I want to ask your mom. You got to ask your mom.
Yeah, oh, I will.
You know who's going to be upset too? It's a business traveler, right?
Oh, big time.
Is George Clooney up in the air, right?
That's another movie.
But think about it. A guy like that gets to go to the lounge. He gets a bunch of miles just simply by business traveling, right? And there's a lot of people that sort of get sucked into that Delta ecosystem with American Express, a lot of business customers. And you just wonder, where does that probably wealthy business person take their business? Because a lot of people stay in that ecosystem for personal travel too, right?
It's really hard to get out. Once you're in, like, you have all these miles, accrued lifetime miles.
I don't fly Delta. I really don't. I'm United, American, probably American.
So you're not collecting. Like, you're just like going wherever is a good deal.
JetBlue. Yeah. I don't have a specific card, but it's something I've been thinking about more and more, especially as airline fares become a lot more expensive.
A final thing on it that I'm curious what you guys think. Do you think people actually move though? This is one of those things to me. It seems like a lot of online uproar. A lot of people are upset. Do you actually take the effort to switch?
I left United many years ago for Delta.
You did?
Or before pandemic.
But you're in New York, where there's a lot of options. There are some people out there that only like
Only United,
have
only Delta,
those hubs.
only American.
So you're sort of limited here. We have the flexibility where, all right, Newark has the United hub.
But if I'm building all these miles and I have Amex, it's like the perfect marriage.
Yeah, I feel like
now I need a divorce.
Once an ecosystem gets me, I'm pretty sucked in, and like I'm not taking the effort to move at that point. Would be my guess, especially if I had a lot of miles.
Very frustrating.
All right.
Very frustrating.
So we're talking about the airline ecosystem, but what about the in-office ecosystem? Because apparently people don't want to go out there and go to post-work happy hours anymore. 5:01. You're off the clock. You just want to go home. It's funny that we're doing this story today because there actually is an impromptu office happy hour that we found out about like 2 hours ago.
Not everyone knows about it.
Well, hello, Yahoo Finance. Anyone come out to the happy hour?
Come on down.
Come on down in New York, downtown New York City. But it did get me thinking about happy hours in this post-pandemic world. Obviously, we saw a surge of this when people were first returning to the office, or maybe not even at the office yet, to try and boost morale. I have mixed thoughts on this. Sometimes I like to go to the happy hour, and sometimes I just like to go home.
I was going to say quickly, we saw some stats here with here's the how this has changed, but also generationally speaking. I feel like when I was younger, there was a lot more enthusiasm to people. Happy hour, great, let's go. And now I'm seeing younger cohorts, people like that, talking about, I want my life, I want my personal life, I want to go work out, I want to go do some other events. And I think we're seeing that it's a generational thing. I think that's what it is, right?
Well, the Gen Z stat that you're looking at right there lines up with a lot of what Gen Z feels about work, right? We talk about a lot of Gen Z work surveys where they just want to do the job and then be done with work, right? They don't want to work extra hours. They don't want to be at the office too long. They don't want to even go into the office. They want to work hybrid. And I think that that's a big part of it is when you're used to a lot of your work week being at home, say you're home 3 days a week and you only go in twice a week.
Did the pandemic change that?
You're very used to being kind of by yourself and doing your own routine after work. So if you have to go all the way to the office, you're already not happy you're going to the office. You can't wait to go back home and get back into your routine and do your own thing. So I do think the pandemic is the big thing that changed that. I think rather than people being excited, they kind of want to go back to their bubble and just get away from the other.
And then conversely, if you are someone that does go in the office every day and you are seeing people every day, sometimes the people you work with, you see more than your friends, than your family. Not to say you're not friends with the people you work with, but sometimes you just want to go home.
Allie's sick of us.
No, I am not sick of you. I do enjoy happy hour, but like we had a happy hour on Monday. Apparently there's one tomorrow, maybe. There's one today. I'm like, when will the happy, and I'm
People want to hang out too much.
It's a big week.
I'm trying to be healthy, I'm trying to go to the gym, and now I'm at these happy hours.
We'll bring some drinks here tomorrow, have some drinks before the other happy hour.
All right. So we'll may or may not see each other later at the happy hour, but we will see you on the other side of this break. Coming up, we have much more Yahoo Finance Live. Stay with us.
As the NFL season heads into week 2, sports betting is shifting into high gear. And one company is offering a new way to gamble on your favorite players. Sports marketing platform Mojo has launched Mojo Fantasy, allowing users to build a portfolio of players from the NFL and the MLB and trade in real time. For more on that, we want to bring in Vinny Barrara. He's co-founder of Mojo, also CEO. Vinny, it's good to see you. Thanks so much for taking the time. Let's talk about this new launch and your strategy behind it. Why get into daily fantasy?
Yeah, so as you mentioned, we've launched prior to the fantasy. We have an online regulated sportsbook in New Jersey. The idea is to bet on athletes and teams like stocks. We've seen a lot of traction in that sportsbook, but it's a small audience in New Jersey, only 3% of the population. And so the idea was, how do we quickly expand this offering to a much more national audience as fast as we can? And the way to do that was we created a new app, a new product based on our sportsbook. That's a fantasy version, which now allows us to get into states like California, Florida, Texas. I can explain how it works, but the impetus was, how do we get the core of this product into the hands of as many people as quickly as possible, given the traction we've seen in New Jersey?
You certainly got a lot of interest from people who are watching. Walk us through how this works.
Yes. So the idea of Mojo, again, I'll start with the sportsbook first, because I think you can understand how the fantasy version is. But the premise is, we think it's pretty cool for the everyday sportsman to basically bet on sports like stocks. So what we mean by that is that anything that you'd normally bet on, whether it's a team bet or an athlete or an over-under or something like this, what we do is we create a Robinhood type UX. So it's very simple and less intimidating than a lot of the other sports books. And the core functionality for the customer is, there's this liquidity. They can always get into a bet and out of a bet at all times at the latest odds. And we do that as the game is being placed, as the game is happening. So it's an incredible second screen experience, or an incredible live experience, I think, unlike anything that customers are used to. And now the fantasy version of that is, it's limited just to players. So you can't start betting on teams. You have to pick 4 of those players, and you're competing against other people in these contests for money, so real money. But that's what makes it legal.
Vinny, who's your target customer? Are you going after the same person that maybe bets daily when it comes to DraftKings or uses FanDuel? Is that your target customer, or are you looking for somebody else that maybe has not been interested in sports betting before?
It's a great question, and I think we've got multiple targets. We definitely have the same customer in some respects as the DraftKings and the FanDuel. We're folks that just like to basically gamble or play fantasy, but I think we bring on a new customer as well, someone who likes to trade stocks, familiar with Robinhood, doesn't like the intimidating nature necessarily of how some of those sports books operate. So I feel like and we've seen this so far, we've brought in a lot of younger folks who don't gamble or use those other platforms a lot, but who truly get how Robinhood works. So it's kind of interesting.
Can you talk a bit about the expansion and where you see the opportunities? I mean, naturally, we're looking at sort of bigger markets as being the big driver. You launched last year in New Jersey, but when you think about the opportunities that are out there, I mean, where do you see the biggest revenue drivers?
So yeah, we focus a lot on what we think live is the future. Live betting, live gameplay. That's really interesting, because when you look at Europe, 80% of the activity is live. In the US, we're behind them a little bit, because gambling is only 5 years. It was only legalized about 5 years ago. So we think the trend is all going to be about who has the best live experience. That's why our product is geared towards that, this sort of second to second latest odds, pricing, tracking the game, all the volatility, the ups and downs of the game itself. that's our focus. We think that's where the future is.
Vinny, when you take a look at the sports betting landscape right now, you have many competitors within the space. Obviously, you have DraftKings and FanDuel, like we alluded to before, but then you also have new entrants this year when it comes to ESPN Bet. You have Fanatics also jumping in. When you talk about distinguishing yourself further or really capitalizing on that potential market opportunity, growth opportunity there, how big of a threat do you think some of those more traditional players are?
Yeah, I think the key, as you just said, is going to be who differentiates their product the most. From where I see it, I think they're all incredible companies, but they're all offering mostly the same exact product. Like you can find the exact same bet, the same exact appearance on all of those. So I don't necessarily see so clearly the differentiation between all of those platforms. The main thing there is the marketing that they're doing. They have a ton of money and they have rewards and offers and promos. That's sort of how I think that game is being played. So I think the future will be who can come out and create the most differentiated products and separate themselves on the core value proposition. And that's why, we focus a lot of money not on marketing, but mostly on our technology and our product and our UX, and then this idea of the live experience and the liquid dynamic that we offer, which we think is truly different.
Vinny, I'm curious to get some intel on where the bets are being placed, specifically on the sports book. You were talking about, look, you can bet on athletes, kind of what you would do with stocks. How many people have their money on Aaron Rodgers?
Oh, it's a great question. So I don't know. I have to get the exact number of how many people actually had bets on him. One thing that's very unique, and I didn't really get into it yet, is we have a certain bet that we offer where you can bet on the future career of an athlete. Like you can't find that anywhere else. So on Aaron Rodgers during the game, and the most unfortunate thing, because when he suffered the injury, there was a lot of doubt now on his future career. So his price went down 50% automatically, immediately. And what's also interesting is that Zach Wilson's price, the backup quarterback, went up 20% instantly as Aaron Rodgers went down 50%. So that is the kind of thing that you see when people are sort of trying to figure out what is the future career of this athlete. That's, again, something you can't find anywhere else that really resembles a stock market.
It's interesting. I was wondering what would happen if you had one of the players that had unfortunately been injured in week one. Vinny, great to have you. Thanks so much for joining us and the insight there. Vinny Barrara, Mojo co-founder and CEO.
Thank you.
Well, coming up, it's closing time here on Yahoo Finance. We will recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned. Let's take a look at Lennar. It's flat here in extended trading. The company just reporting earnings results here. Revenue beating the street's expectations, $8.73 billion there for the home builder. Earnings per share also coming in better than expected. The fourth quarter delivery outlook was strong, 21,500 homes to 22,500 homes. That was better than what the street was looking for. Net new orders up 37% on a year-over-year basis. We talk about the inventory issue across the country. Existing home sales under a significant amount of pressure. As a result, more home buyers are turning to new homes because of the lack of options on the existing home market. So some of these home builders really benefiting from that. You could see that with that 37% jump on a year-over-year basis in new orders. New home deliveries were up 8% during the quarter. The gross margin on new home sales was 24.4%. That was also higher than expected. And the commentary here in this release, Lennar executives saying that the cycle time driving down 32 days in terms of deliveries. And a lot of that is thanks to improving supply chains, also the ability to get workers. So they're seeing some improvement in the delivery times here for the current quarter. It was down 32 days. So not much moving here in extended trading, but a beat for Lennar on both the top and bottom lines.
Yeah, I mean, Shana, it certainly feels like you can't build fast enough right now, right? When you think about where inventory levels are right now, certainly a lot of optimism that Lennar can keep this kind of growth or that it's sustained because of where the housing market is right now. I'm looking at Mortgage Bankers Association index, that where those applications were for home purchase loans, down 27% year on year last week. So there's the interest rate story, but also the inventory story. Lennar certainly in a position to be able to take advantage of that. Well, it's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. ARM Holdings shares jumping 25% in its Wall Street debut. The chip designer priced its IPO at $51 per share. It still will be controlled by SoftBank, though, given that they hold a majority of the shares. After the debut today, there's growing optimism that the IPO market is thawing. The next IPOs the markets are waiting for include Instacart and Klaviyo. Mortgage rates back on the rise. According to Freddie Mac, the rate on a 30-year fixed-rate mortgage ticked up to 7.18%. This marks 5 straight weeks that mortgage rates have been above 7%. The news comes ahead of a batch of housing data next week, including home builder sentiment, housing starts, and existing home sales. And finally, President Biden's son, Hunter, has been indicted on federal gun charges. This comes weeks after a plea agreement on tax and gun charges fell apart. This now sets the stage for a possible criminal trial next year as President Biden runs for re-election.
Well, here's what to watch on Friday. We will likely see the UAW strike. The clock is ticking as a deadline of 11:59 p.m. approaches for Detroit's big three automakers to solidify a deal with the United Auto Workers. The union saying that it plans to execute its targeted strike plan against an undisclosed number of plants should a deal fail to be reached. We will be watching that unfold tomorrow. ARM shares surged today, closing up 25% after originally pricing its initial public offering at $51 a share. Right now, you're looking at the action in extended trading. We will see how the much anticipated IPO fares in its first full day of trading tomorrow. Plus, pre-orders for Apple's new iPhones kicking off tomorrow. Will the tech giant's newest product updates be enough to sway consumers towards its highest priced iPhone ever? We will find out once we see what demand looks like here in the first couple of days that it's on sale. Well, that does it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here again tomorrow.